because what's happening is that, and I talked to someone on a podcast that we're doing recently that's coming out, I think, this week, about that exact question. Why are people so concerned, and why is this viewed as a bubble as opposed to natural growth of moving loans from the public banking sector into the non-regulated, which is what the regulators wanted? And he said, because it's new. It feels new. It's not public. These loans are not traded. These are middle market companies. And part of that is just getting educated in the asset class. You guys have been doing a great job in doing that and helping me get the word out. I think Mark Rowan Apollo pointed out the fact that it's really investor education, and the more education there is, the better that we look. But the fact of the matter is that this is actually a natural evolution away from traded assets where the banks were considered to be not healthy holders of these loans. And so the private credit market has responded to the immense amount of appetite because of so much of market volatility. These loans are untraded, and illiquid loans, as opposed to being a negative, are viewed as being positive to a lot of investors, institutional investors, who are looking to allocate to non-traded, non-volatile, less correlated assets. So the reason that the asset class has grown so much is because the investors are looking for alternatives to the 60-40 correlation, the allocation model that we talked about. And at the end of the day, these are middle market loans. These are low risk, relatively low levered, fully secured with financial covenants. And so think of private credit as middle market lending for grown-ups, okay? Yep. It's very stable lending that is being now packaged in multiple funds, very diverse investor base across many, now thousands of investors who are investing in this asset class, who have experience in other complicated asset classes such as real estate and private credit and public equities and fixed income. And so it's actually meeting a demand, and the demand is growing as more investors realize what an opportunity and benefit it is.
What is your investment approach for private credit, specifically for your clients? What do you advise them to do and how to have that exposure?
Yeah, so we're also very fortunate to be owned by a very large entity called TIAA, which is their holding company for Nuveen, which is a $1 trillion asset manager. And they have hundreds of billions of dollars in fixed income and public equities and real estate and municipal bonds. And what their investors are looking at, the same thing as our investors at Churchill are looking for, is this stability of returns. And so in a normal environment, a senior credit, we've talked about this, will get you kind of a 7% unlevered yield. In the current environment, which is why it's very attractive right now because rates are up, they're earning a 12% unlevered yield. And so when they look at the returns of 12% versus what they're getting in other markets, we're representing a lower risk profile. And so that's adding to the appetite that these investors are looking for. Now, in our case, we can offer them senior debt opportunities. We can offer them junior capital. We can offer them private equity. So we have a number of asset classes that we're also offering our private equity sponsors in terms of their financing options. So we're taking the same financing choices that we're giving our clients on the financing side to the investors on the investing side. And that's what makes the sort of nice balance, which I think as investors and frankly the media and regulators get to understand the asset class. This is not fast money. This is money that investors are focusing on long-term assets with us, long-term liabilities, because these loans don't disappear tomorrow. They're not traded. And that kind of stability is really at a premium right now.
Who is a typical investor in one of your funds?
So, yeah, we don't really have typical investors. We have them from a broad array of types of investors. So we have pension plans, we have wealth funds, we have sovereign wealth funds, we have insurance companies. And essentially, as more and more investors, particularly sophisticated investors, are looking at their options in this higher for longer world, they're thinking, I need a premium yield because I can get 5% on treasuries right now, but I also want stability. And those are the things that are attracting now even further down the food chain in terms of family offices and retail. And I think as the asset class grows, and we're calling it kind of the new paradigm, as investors look at the benefits that private credit is offering, and they're seeing some very sophisticated players in this market. They're saying, how can we participate in this asset class?
Do you see any red flags that are bubbling up in private credit? Any corners?
Yeah, well, the thing that is most, I think, concerning to anybody who has experience in the asset class is high interest rates. Because the thing that, when you look at your portfolio with rates now at 5.5% from a benchmark perspective versus zero a year and a half ago, the interest coverage is shrinking across portfolios. And so everyone looks at that as a risk, and it's a real risk. And so you have to build a portfolio that is ready to accept those higher rates. And the way we do it is we look at very defensive sectors that have high free cash flows, that are owned by private equity firms who can grow these businesses to keep pace not only with where GDP is, but also where some of the higher growth sectors in areas like healthcare and business services are going. So to give an example, the average growth in both revenues and EBITDA in our portfolio right now is about 12.5%. So when you look at the GDP, which is bouncing around 2, 3, 4%, something like that, you're looking at businesses that we think will grow through whatever cycle is coming. It looks like probably a soft or no landing is going to be expected. But our businesses are really faster growing than that. But they also tend to be businesses that are market leaders, that will be able to sustain any kind of downturn, even if we do have it.
What's the deal flow you're seeing from your private equity sponsors? What's it been like today in this higher interest rate environment?
We just got the October numbers. We are the most, as of the end of October, the most active direct lender in the market right now in the United States. The reason that that's happening is that our private equity sponsors continue to have dry powder that they are raising in their own funds. They wanted to put it to work. They've identified areas of interest, as I mentioned, in these defensive sectors that in this current economy are doing well. And they realize that next year is probably going to be a better year than people think, probably not going to have a recession. And so they're trying to vote with their feet, and they're looking for scaled players like Churchill that can write large checks where we have relationships. And I think I mentioned this last time, we're an investor in their funds, and so we're sort of first in line to be asked to join these deals. We still tend to be pretty picky. We probably do about 5% of the deals that come in the door. So we're looking for only the best of the best, knowing that we don't know what's coming next year. I mean, think about where we were 2 or 3 years ago with COVID and interest rates. And the good thing, and this goes back to this issue of a bubble, these middle market companies have been tested. They've been tested through low rates. They've been tested through high rates. They've been tested through low inflation. They've been tested through high inflation. And so I think the benefit that needs to be explained more, and this is part of this education, is why these companies actually do well, in some cases even better than some of the larger companies, because they tend to be in structures that are more conservative, and also with lending partners such as ourselves that are basically built for the long run. We're going to work through whatever problem these companies have to get to a final resolution that's a positive one.